Welcome guys to today's episode. This is actually the continuation of the series of the episode on order flow shifts, break of structure and shift in market structure. Okay, the reason why this video was is splitted into two parts is actually because during the time of making the previous episode, my software kind of crashed, and the first part was actually the only part that got saved. Okay, so that was why we had it in half. So I apologize for that, and so this is the second part of it and the final part of it. Okay, so if this is your first time of coming across this channel, please do well to subscribe, turn on the notification bell to get notified when we upload weekly content. Okay, so let's get down to business. All right, so now looking at this price action right here. Okay, this is the dollar index. Okay, so now in the terms of break of structure, we have this as our trading range. Okay, we have this short-term high down to this point where the market started retracing from. Okay, so we have this short-term low right here. Okay, so now this will be our current trading range until this occurs. Okay, until we have this break of structure to the downside, this is our range. Okay, so now once this breaks, this becomes our new range. Okay, so now this is a break of structure in terms of expansion, and this is break of structure in terms of retracement. Okay, so this is the 50 minutes, as you can see. Okay, then this was our current trading range. Okay, until we had this break of structure right here, and eventually the market gapped down. Okay, so now taking a further look at what I just explained. Okay, we have this as our trading range low, because like we learned earlier, before the market starts retracing, it has to create the three candle pattern, right? It has to create a swing low, a candle that has a low, a higher low to the left side and to the right side of it, right? So now we have that right here. This will be our swing trading range low, and this will be our trading range high. Okay, so this is our current trading range. When the market broke down, break structure to the downside, this then become our new range. This is our range low and our range high. Okay, then this will be considered as a break of structure to the upside. Okay, a break of structure into a retracement phase. Okay, so this will be break of structure as retracement. Okay, so now how do you identify your range? Okay, how do you identify your range? In most cases, like as we can see here, right here. Okay, we have this short-term low, right? We have this short-term low, and we had this retracement. Then now the market started trading lower, started consolidating rather, because as you can see, it's stuck between this range high and this range low. Okay, it's stuck in between it, so it started moving sideways. Okay, so now we had this. What would then be our current trading range when this low was taken out? Okay, how do you identify your trading range high? The short-term high that broke the short-term low, that took out the short-term low, that will be viewed as your current trading range. Okay, in other words, this is our current trading range. We have this swing high right here that broke this short-term low. Okay, so this down to here is a new trading range. Then we had the market gap down. Remember, for every break of structure, there have to be some sort of short-term low or short-term high taken out, right? In this case, as you can see, we had this short-term low taken out. We had this short-term low again taken out right here, and our trading range high was currently here. Okay, was currently here until we had this break of structure to the downside, right? Then we have to move our trading range high from this particular short-term high to the swing high that broke structure to the downside. Okay, in this case, we have this swing high right here. Okay, we have this candles high then we have a higher high and a lower high to the right side of it. Okay, so this is the swing high that broke, that took out this short-term low. Okay, so now when the market gapped down, eventually, as you can see, we had this swing high formed right here. Okay, and we have these candles, then we have the higher high and lower high to the right side of it. Okay, so this is a swinger, this is a short-term high. Okay, well, I took out this short-term low right here. Okay, so this was our current trading range until the market gapped down eventually and took out this short-term low. Okay, and what is the swing high that took as this short-term low? That is this particular swing high. Okay, so that is how to identify your range. That is how to filter out the swing high when you have multiple swing highs in this, like in this scenario. Okay, in this case, you see, as we can see, we have multiple short-term highs, right? We have this short-term high, we have this short-term high, but the one we are mostly that we are interested in is the swing high that takes out the short-term low, that takes out the short-term low. Okay, so looking at this in this place, you can see that we had this short-term high, consolidated a bit, then we had another short-term high. Okay, why did I use this short-term high instead of this? Okay, because this short-term high didn't take out this short-term low. Okay, it was this particular swing high that broke structure to the downside. Okay, so that is how we identify our trading range. Okay, the short-term high, if this was an uptrend, okay, this would have been our short-term high, short-term low. Sorry, if this was like an uptrend, okay, this would have been our short-term low, because this particular swing low, you can see we have two swing low right here. Okay, although this one is not that visible, okay, not that long of wick, more like equal lows. Okay, but we have this short-term low that broke this short-term high. Okay, so this is our trading range low. Okay, this is our trading range low. Okay, so that is just how to identify your trading range. Okay, the short-term high or low that took out that breaks structure to the downside, or that shifts structure, okay, that changed the underlying trend. Okay, so now we had this short-term high, but it didn't take out this short-term low, because this is our new current trading range. Then we had this short-term high that broke structure to the downside. You can see the market expanded lower before creating a new short-term high. Okay, so currently this is our trading range. Okay, so now I hope we are clear with that, on how to identify our trading range and how to differentiate between a break of structure as an expansion and a break of structure as a retracement. Okay, so let's go down deeper. All right, now we have this price action right here. Okay, we have the opening price, of course, then this is our London Q zone, the opening price for London Q zone, then the opening price for New York Q zone. Okay, then we have this break of structure to the upside. Right, now let's look. Our bias is bearish. Okay, our bias is bearish, has been bearish on the dollar lately. Okay, our bias has been bearish on the dollar lately, and I want to draw your attention to this short-term low. Okay, so this short-term low right here, we have price, trading, price traded off this short-term low, expanded higher, then came back and respected it. Okay, so this is engineered liquidity, right? So this is smart money engineering, or rather the algorithm engineering a kind of support level, creating a retail support level. Okay, so we have price bounced off a little bit and smashed through. Okay, then price smashed through. Okay, then it started retracing. Okay, so this was where I actually got interested in the market. Okay, when we had this run, this when we had this run upwards, okay, there was no short-term high apart from this. Okay, but I was not around when this happened. Okay, so I came up to see the chart in this particular price action area. Okay, so when this happened, that was where I started hunting for my setup. Okay, so now when we talk about points of interest, I want to make an episode on that. I discovered that for smart money traders, the minimum point of interest we have is theory. Okay, the minimum point of interest we have is theory. We have to have one on the higher time frame, which is the daily, the 4 hour, So as smart money traders, we ought to have 3 point of interest, right? We have to have a point of interest on the higher time frame, let's say the daily or the 4 hour, for example. Then we have to have a point of interest on the intraday charts, okay, on the intraday charts, which is or the intraday time frame, which is the 15-minute time frame. Then we have to have a point of interest on the 1 minute time frame, okay, on the 1 minute time frame, which is our execution time frame, or the lower time frames, which are the 3, the 2, 4 minutes or 5 minutes. Okay, we have to have a point of interest on it. So that's 3 points of interest. Okay, that's 3 points of interest that surrounds any trade setup. Okay, so in this case we had this move. Okay, there was no, I didn't highlight the point of interest from the higher time frame, which is from the daily time frame or the far rather, but I had a point of interest on the intraday chart. Okay, so my point of interest was actually when we had this displacement. Okay, when we had this displacement, bias was bearish. Then when this retracement started happening, okay, so this was my point of interest. Okay, so I was looking to hunt for my setup right here. Okay, so this is my intraday point of interest. Okay, so now this is our trading range high, because this is the swing high, the short-term high that took out this equal lows, right? That that smashed through, that took it off. Okay, so now we had this retracement, and when price got in here, I had to once price trades into your point of interest, go down to the lower time frame for lower time frame confirmation. Okay, so let's go down to the lower time frame right now. So this is a 3 minute chart, right? So we had this break. This is our shift in market structure. Okay, why is this our shift in market structure? Because we have this displacement, right? Then we have price creating a short-term high right here. We have this short-term low, then price smashed through, right? Then this was our current trading range. This was our current trading range. Okay, in other words, for this range, for this trend to go bullish, to shift in structure, this range would have, this trading range high, this range high right here, this old high right here, have to get taken out, right? But in this case, we had another lower high that took out, that broke structure to the downside. Okay, so we had this high that broke structure to the downside. So this became our new high when price traded through this, when price took out this old low. See, so this was my range, trading range. Okay, so this became my new trading range, though, and it shows that price is still eventually bearish. Okay, so I'm waiting on a retracement back into my point of interest. Okay, so I had to wait for a shift in market structure to confirm that the price is actually retracing, right? So I was looking at this short-term high, so price started retracing. I was just watching price, I was doing nothing. I was just watching price to shift to a bullish uh market. Okay, so when this old high got taken out right here, then I knew that the retracement has already begun. So now when price traded into my point of interest, so this price got into my point of interest, created a high. So what is my swing low? What is my short-term low? Okay, what is the low? Notice we have this short-term low right here, this a short-term high, not much of it. Okay, we had this short-term retracement, right? Then we had this swing low formed down here that broke structure to the upside. Okay, so and you can see that price just expanded one way, right? So this became my trading range. Okay, so I had this low to this high. Okay, so for market, and price is already in my point of interest, right? So now for market to confirm that it has shifted in structure bearishly, I have to see this low okay, I have to see this low taken out. Okay, so I have to see this low taken out. So now, as you can see, price was just consolidating, and I didn't do nothing throughout this. Okay, I was just watching price, I was watching this old low. Okay, I was waiting on price to take out this old low to confirm that price have shifted in structure bearishly. Okay, so now, and that was what happened right here. Price smashed through aggressively. Okay, so price took out this short-term low, and I knew it has shifted in structure bearishly. Okay, so when price retraced, okay, let's go down deeper. So we had our shift in market structure right here. So we had this. when this got taken out, so I waited and took out my fib. Okay, so what's the swing high that broke this, that took out this short-term low to be my trading range high? Okay, so what will be my trading range high now? Because of course we have multiple short-term highs right here. Okay, we have this first swing high, then we had another swing low form of a retracement, short-term retracement. Then we had this relatively equal highs that created this swing high pattern. Okay, we had these candles that is lower to the right side and this to the left side. Okay, so the left and to the right side. Okay, then we had this aggressive move downward. Okay, so this was obviously the swing high or the short-term high that took out, that broke structure, that shifted structure bearishly. Okay, so this was my range. Okay, and then I had to wait until price indicates it indicate going into a retracement phase. Okay, by creating a short-term low, right? So when I had this swing low, I knew price was going into a retracement phase. Then I took out my fib, but eventually we had this minor grab on liquidity. Okay, and I was still watching price. So I had to adjust my fib to the new trading range low. Okay, so I had to adjust my fib to the new trading range low. Then we had this move into premium sector. Okay, so this was my entry point of interest. I entered right there. Okay, I entered right here. And we always talk about when we have a situation whereby we have two fair value gaps, we have to give room for our stop to go higher. Okay, we have to give room for the second fair value gap, the possibility of price reaching for the second fair value gap, right? So my stop loss was above this candle. Okay, so we had this move and price of course went back, took out this short-term high again and traded into the second fair value gap right here. Okay, so as you can see, price traded into the fair value gap, the second fair value gap, and took off. Okay, so now I had this old low, of course, as this equal low as my target, and so that was a risk reward of 3 to 1 if I'm not mistaken. Okay, so that's good risk reward of 3 to 1. So now I hope we have been able to understand the concept of what a shift in structure and what a break of structure is. Okay, so now what this help us to do is to understand our trading range. Okay, the break of structure will help you to understand your current trading range. The shift in structure will help you to understand that the underlying trend has changed. Okay, it informs you of the change in an underlying trend. Okay, so that is just all for today's. Okay, the next episode is going to come up very soon. Like I said earlier, I didn't actually write down a table of content for this past money model. Okay, so I'm just creating it as we go. Okay, but we'll get to the PDRs, which is the utmost focus of this series. Okay, we're going to get there very very soon, but there are some concepts, some of the tools that I don't want to leave out of the series. So as we proceed forward, I'm going to be adding them eventually. Okay, so we still have a lot and lot of information, lot and lot of things to talk about. Okay, so stick around, and if it's your first time of coming across the channel, please subscribe to this channel, share with friends, give these videos a thumb up if you enjoy it, and I'll see you in the next video. Okay, have a good trading week.